Good evening, everybody. Thank you very much for joining in. This side, Rahul Magan here as the Chief Executive Officer of Treasury Consulting LLP. And as you very well understand that our YouTube channel is bringing a lot of new videos from you every day. So this time we are coming up with a video which has recently on an article which has been recently published in the live main, and this is on a hedging. So we would like to bring to you towards a few negativity about this article and what are the mistakes the editor has done in that, and also a few important things which article is sharing. Basically, the live mint is sharing. Now, what is this article first of all about? This article is about the premium, and basically this article is not all about premium. This is about the swap annualized premium. Now, premium, we all know that it is a time value of money which either you pay or you receive. Pay means if you are an importer, you want to cover your payable. Receive means if you are an exporter and you are selling your receivable. It is all time value of money, and the way how you calculate it, a lot of time we demonstrated on our YouTube channel. This is done using interest rate parity. But at a different way, if you look from a different way, we have another way to calculate the premium. Now take a simple example. If today somebody is saying that 1 year premium is 2 rupees and 56 paisa, which is 256 paisa, and the spot is trading 68.22, which I'm taking a February close, which I'm taking the Friday close, then in terms of the annualized premium, this stands approximately 3.75%. In terms of annualized, this stands at 3.75%, which is the premium. 3.75%, which is the premium. Now, unfortunately, what is happening that we always tend to calculate the premium in absolute figure, but we never calculate in the relative figure. We should always calculate in the relative figure. Now, take a very simple example again. Now, recently, due to several factors, I'm not saying that demonetization is a very important factor, but yes, demonetization played a little role here, because a huge amount of money that has been came in the banking system, and we strongly disagree with the fact of the hike in the CRI by Reserve Bank of India. We always believe that. I think they should have done with the sterilization operation of that. But nonetheless, that is something for which we are not here. Now, if you read this article, you will get to know that the 10-year government's GSEC yield is trading at 6.18%, which is low, and it is getting low. Now, INR premium 1 year is trading at 2 rupee 56 paisa, which is very low. When I left my job in 2016 as a corporate treasurer and started my own firm, I still remember it was 4 rupee 20 paisa, and a few months ago from this, which was roughly January 16 or so, it was 5 rupee 40 paisa, which was much higher. Now it is decreasing. Now, sitting today, 1 year premium is trading roughly 3.5 to 4%, which is a very low figure. Believe me, which is a very low figure. But unfortunately, if you read this article, you will get a wrong figure of this. He is saying that the premium is falling. So what you should do, that it is a benefit for an importer. Now, if you look at these two charts, which is right up front here, this is 1 year forward premium, and this is 3-month interbank forward offer rate. 3-month Mumbai interbank, this is MIFOR. So please don't take MIFOR into consideration, because this a particular person who has brought this article is not aware about what MIFOR stands. Because MIFOR, I'm not saying that the swap annualized premium has nothing to do with the MIFOR. In fact, how you calculate, the MIFOR is nothing but the sum product of your swap annualized premium and LIBOR. So if this particular person is saying that 30th November the MIFOR is trading at 4.08%, on the other hand 3 months MIFOR, and on the other hand he is comparing this with 1 year dollar premium, then there is a considerable catch in this. Because if you are saying that the 1 year USD INR premium is trading at 6.06%, which I strongly disagree, to be very honest. But nonetheless, and then you are comparing this with 3 months MIFOR. This is not in agreement of the fact. This is not in agreement. But nonetheless, let's move forward. So what he meant to say that the premiums are falling. Now, if you look at this article, now this article is saying that this is a bonanza for importer, because the premium in percentage term is getting down. I wanted to ask from this writer that if premium is getting down, if the swap annualized premium is getting down, then the spot is getting up. Today's spot is 68.22, and there is a big probability that it will move towards 69, not 68. Yes, I might not be surprised that for a temporary phenomena it might decrease to 68 also, but it is heading towards 69. And in my personal opinion, 67.80 or 67.60 seems to be a very good call to hedge from the payable side. So from my standpoint, the premiums are falling down. This is the good news for importers, and this is the bad news for exporters. On the other hand, the spot is up. Considering the way that things are moving in the Indian financial system, I seriously don't think that Indian rupee is heading towards 68. In my personal opinion, it is heading towards 69. I am more hawkish than the Dovish person. In my personal opinion, Federal Reserve to hike an interest rate soon and twice by December 2017. The voting for the Italian referendum, which is going on today, this is also one of the fantastic things which is happening. And if this would happen, of course, this is a constitutional. The voting is heading to do constitutional amendments. But over the period of the time, the talks are also going on that the Italy would quick euro, and Italy would quick euro. This will push a pressure on the euro. If this will put a pressure on the euro, ultimately the Indian IT companies have more than 30% exposure in Europe. They would gone. So things are on the chain basis. What is the second mistake which this particular person is saying, this particular article is saying? Now I'll read this paragraph. This paragraph is here. I'll read this. This drop in the hedging cost comes as an opportunity time as the global interest rates are still low. First of all, global interest rates are not low, except few countries, which is Tokyo, which is your Swiss, and which is your Europe, where interest rates are negative, and they would continue to be negative. Now, move forward, a top-rated Indian IT company can borrow L plus 200 above LIBOR or around 3.3%. I would like to ask a simple question from the particular person who wrote this. That first of all, it is the QSD, quality spread differential, that will determine what should be the cost of the top IT company. Until otherwise you are measuring quality spread differential here, there is no point that you should say that if today a particular company would be hedging, would be taking a borrow, then they would be take at 3.3%. And especially when you are not mentioning the tenor. Another mistake this article has done is that on a fully hedged basis, the cost of borrowing would be 7.5%. Now this he is referring to MIFOR, because the MIFOR is nothing but swap annualized premium into the LIBOR component. Again, a big mistake. If practically speaking, if you are taking a 10-year loan, external commercial borrowing, and somebody would ask you that you wanted to hedge this, right, and you wanted to hedge this on a complete basis, then ideally it should be principal only swap plus the coupon only swap. But how would you hedge that? But how would you get to know what is the benchmark? This benchmark is nothing but the MIFOR. So if 1 year MIFOR, which is trading at 6%, and on a fully hedged basis you are getting greater than 6%, then you might not be wrong, because MIFOR is not taking USD into consideration, which is quality spread differential. If for a company the quality spread differential is around 2%, and 1 year MIFOR is trading at roughly 6%, then for him the fully hedged is 8%. It is next to impossible, because MIFOR we are calculating on LIBOR. We are not taking any spread into consideration. And further, once we take MIFOR, we need to take an impact of ICAP also, because LIBOR is calculating on a 6 month basis, and if you need to derive on a 3 month basis, then you need to add an ICAP adjustment in that regard. So this is how things would be moving in the financial system. But unfortunately, what is happening, that such kind of articles makes a sense in the market that things are moving in other direction. Also, things are moving in a different direction. I would like to put the same example in the other way. Suppose today 10-year MIFOR is trading at 7%, although it is trading 6.5 something. If it is trading at 7%, and you are taking a 10-year external commercial borrowing at LIBOR plus say 120 basis point, then do you think that the entire principal only swap and the coupon only swap or the collective will cost you 7%? It won't. It would definitely. Even in the best cases, the people will not get the same POS and the COS which they're supposed to get. So it won't be 7%. So this is something which is absolutely wrong, that on a fully hedged basis, this is around 7.5%. Third important thing which this video would like you to tell you right now, all those importers, those who are watching this video, we are requesting them to hedge their payables maximum by 68.70 or 67.80 or 68, because the fact is very sure that INR is heading towards 69. Of course, people are claiming that by January 2017, when the RBI would have met, RBI would meet, then RBI would cut the interest rate by at least 50 basis point. But the more the cut RBI would do, the more reverse carry would happen for Indian rupee, and the more reverse carry would happen, the more dollar shortage would happen in India. And we should not forget that the major chunk of that dollar money which is coming in India, which is invisible, this chunk is getting reduced every day. This chunk is getting reduced every day, and because this chunk is getting reduced every day, it's going to be a loss. It's going to be a no man show. It's going to be a no man show. So the more it's going to be like one arrow and two sparrow. The sparrow one would be that the invisible section is getting down, and sparrow two is that your so-called the 10-year USD 10-year yield, which is not a sovereign curve, but it's a dummy sovereign curve. It is getting down. So things are not good. In the last, we are requesting people to hedge their receivables at 67.80 or maximum by 68. Please don't overlag yourself. At the same time, if at the same time, spot is currently at 68.20. We are expecting this to turn to 68 for a very short amount of time. Then I be expecting it to move forward. And from here, the 1 year dollar rupee premium, which is 2 rupee 56 paisa, if Fed would hike an interest rate by 25 bips, which is in January, and which Trump is saying that he would make it further hike by another 25 basis point, we are expecting that the 1 year premium could reach to even 2 rupees for 1 year, and then it would be a spot game. It would seriously be a spot game. Why it would be a spot game? Things are very simple. Because the premium for 1 year would be what rupee? It is just 2 rupees, and it would further get down. According to an estimate which has happened on the Bloomberg TV, and only the time will tell how accurate would be that estimate. The 1 year, the Fed would hike interest rate at least 2 times in 2017, and if this 2 times would happen, if they would hike an interest rate by 3 times in 2017, then India is all scheduled to face reverse carry, and the premium of Indian rupee will might decrease to 1.5 to 1.75 for 1 year. So please be careful, and whatever you are doing, you have to be careful. You should not keep your exposures unhedged. And while winding up the video, we would like to request all the importers or the exporters, those who are listening to our video, please start hedging using rolling quarterly hedging program. If you don't have an appetite for a rolling quarter, say for 8 quarters or a 9 quarters, which is a long period, you don't have a forecast for that, at least hedge rolling monthly. Please don't do static hedging. Please hedge rolling monthly. If you're not hedging rolling monthly, then it is not good for you. Rolling monthly is just like SIP. So this was the purpose of the video, is to introduce you about a wrong article that has been published in a media, which is giving little different picture, but ideally it should give, and about prediction also of Indian rupee. We are very pleased to share that we have our online academy in which we are teaching 16 courses. You can go to our website www.treasuryconsulting.in, refer our website, refer our tab which is trainings, and see the kind of videos which we are putting in. We're also having a daily, not daily, 3 times in a week circular global treasury update, which we are circulating to people across the globe. And you are also welcome to subscribe the day. Don't forget to subscribe our channel, and if you like this video, don't forget to give a good remark for our video. With this, we thank you very much, and have a great life.